So the Allianz Global Sustainability Strategy was founded in 1999 with two specific objectives in mind. The first was to deliver long-term competitive financial returns, which obviously as an active asset manager is important to us, but even more important to our clients. And we have always believed that investing in a sustainable and responsible way should never mean giving up that financial outperformance. The second part of our objective is to deliver a positive and measurable impact on society. And we do that by owning companies whose environmental, social and governance performance is better than that of the average company, but also by engaging with the companies that we own in order to improve their performance over time. In order to do those two things, we needed to look at companies from the bottom up, so financial fundamental analysis, alongside our own proprietary understanding of material ESG risks. So year to date, performance has been strong. However, it has not been entirely without issues. In November of last year, 2020, we saw the announcement that a vaccine against COVID-19 had been successfully developed. And this triggered what has been come to known as the reopening trade. In other words, all the companies which had been underperforming in 2020 because of economic lockdowns, suddenly the expectations for their revenue and earnings growth for the next year, as everything came back, jumped. So from a very low base, these companies have suddenly put up their earnings and revenue expectations. This has created a dynamic whereby investors looking at where to allocate their money have tried to chase these massive jumps in revenue and earnings. That has created a shift in the market. And what you have seen is that stocks which are known for generating strong, stable, but also high revenue and earnings growth over the long term, their share prices and indeed the multiples that you typically associate with those share prices have softened. Now, those are the types of company that we like. We like those businesses which you can invest in and hold for as long as possible, that are generating high quality cash flows over time. Because of that market rotation, we saw performance in the early part of this year and indeed the later part of last year suffer a bit relative to the broader index. However, what we've done is use that market rotation as an opportunity. In other words, reducing our exposure to names that had really high level of cyclicality or higher level than we would usually expect, which saw their share prices jump. And on the other hand, increase our positions in some of the names that we like over the longer term, but in this period have weakened in terms of their share price performance. Now, we're talking in July, and performance-wise, as of the end of June, already was starting to show the benefits of this approach. This is because investors who are sometimes emotional and short-term in their outlook have actually started to look through the recovery trade and look through into not only 22's earnings predictions, but even longer through to 2023. And so those high quality names that we like in the portfolio have started to outperform once again. Our philosophy is not predicated on predicting markets. What we try to do is own companies that can outperform regardless of economic cycles. However, that said, we are clearly aware of what is happening in the market. And the main thing which is currently dogging investor commentary, the media, wherever you look, is inflation. And the big question at the moment is whether inflation, which is clearly rising after a low base from last year, is going to be permanent or transitory, and what that means for the companies that people hold in their portfolios. Now, there are two schools of thought on this. One is that you own the stocks which are going to be benefiting from all those price increases, so often low quality or value stocks like energy names, materials, mining, etc. Or you can take the approach which we do, which is to own the types of company which are able to offset any sort of material adverse impact from inflation, i.e. raw material price increases, by virtue of their strong pricing power, their brand strength, or their technological edge. Now, we believe that latter approach lets you look through the short-term economic cycles and actually weather the volatility over the long term. So I've sort of tried to have my cake and eat it there by giving you a view on the economic outlook, but at the same time saying, you know what, in our portfolios, you should not really have to worry about it. Yes, there is in fact, and this feeds directly into something that I was just mentioning in the outlook. So a company that we have bought into is one of Europe's largest producers of wood-based materials. And this company, although it has historically had some quite cyclical characteristics through its exposure to demand for essentially the raw material of wood and also the products that are made from it. So, for example, lumber, pulp for paper, and packaging. What this company is starting to do is to start to have more and more high quality characteristics. And this is driven mostly through management. So driving efficiencies, increasing the operational efficacy of the company. But there is also a long-term structural demand trend, which is that people are looking for ever more sustainable materials to produce their buildings, their packaging, but also increasingly technologically advanced things like anodes for the production of aluminium. So this company is benefiting from both a cyclical but also a long-term structural demand trend. And in the recent quarter, we saw that this valuation looked very appealing for us in terms of underestimating the long-term potential of this stock. And finally, from an ESG perspective, it has a very strong track record of being a responsible business. The company is overall a net negative emitter of CO2 emissions. Governance policies are extremely robust, and the innovation-centric culture of the firm reflects very well both internally and externally, meaning that employees are satisfied, they have no issues retaining talent, and the long-term projects that the company is working on are in good hands.
Allianz Global Investors.